Most investors are missing one game-changing shift happening right now. AI's transformative impact on markets. Now it's reshaping strategies on Wall Street and Main Street. If you think you understand the market today, think again. Adam Parker, a seasoned Wall Street strategist and founder of TriVant Research, breaks down how AI is not just a buzzword, but a powerful tool that's turbocharging research, risk management, and even how retail investors can compel in a high-speed, data-driven era. In this episode, it reveals how AI automates data integrations, accelerates analysis, and exposes opportunities and risks that most stay blind to. You'll discover why professional firms are leveraging natural language processing and machine learning to predict market moves, evaluate corporate health, and manage portfolios more effectively than ever before. We also explore the quiet revolution behind the scenes, from the impact on chip stocks to the disruption of traditional valuation methods, giving you an insider's view on what's next for the markets. Why does all this matter? Because ignoring AI's influence today could leave Main Street behind as Wall Street transforms into a machine. It's a powerful battleground. Adam shares crucial insights into how retail investors can adapt, avoid common pitfalls, and leverage new technologies to build wealth. Perfect for investors, entrepreneurs, and financial enthusiasts eager to stay ahead of the curve. This episode arms you with the knowledge, tools, and information to navigate the coming market shifts with confidence. So whether you're a seasoned pro or just getting started, understanding AI's role in finance today is no longer an option. Hit play now and unlock the future of investing. Hope you enjoy the episode. There's a great reenactment at the beginning. Great acting. Thanks, Main Street.
The two you.
Two what?
The two Utes.
What'd you say?
The two Utes, Your Honor. Yeah, we just said Utes. And to some folks on Main Street, when you hear the noise and the news that's happening, it can be as confusing as that great scene from My Cousin Vinny. Welcome to Main Street Meets Wall Street, a new podcast series that we're putting out just helping Main Street meet Wall Street with financial information, financial literacy. Honored to have Adam Parker on here today. He's a founder of TriVant Research, really smart guy. Coming to you from Wall Street South down here in Charlotte. Today, we're just going to jump in, let Adam talk about a little bit about all the information that just came in today. A lot of stuff just happened right before we hopped on. We even just got off a call with a journalist from the Charlotte Business Journal talking about SCOTUS and tariffs. We'll let Adam tell you a little bit about how his industry and his firm can't be disrupted by AI, how it's actually a tool. And then Adam would tell you a little bit about himself. He's a Tar Heel, so I'm glad you didn't say you wanted to do because we probably couldn't have done this call. So without any further ado, here goes Wall Street. Here's Adam.
Hey, Marcus, thanks for having me. And for those listening, we do have a financial insights newsletter we publish. It's called TriVant Research, TRIVECTOR, like magnitude and direction vector. And you can just go on. We do monthly Zooms. People can ask questions. We do ETF analysis. We give people, advice about staying fully invested in the equity market or other kind of big picture items, sectors that we like, industries we like, et cetera. So let's sign up at our website. And if you say, you know Marcus, you get 1 month for free. So that's no problem. So yeah, TriVectorResearch.com. Check it out.
You had meetings this morning. What is institutional money talking about right now, right? What's talking about versus Main Street?
Our other business, Trivariate is our core business. We sell research, insights, events, bespoke services to institutional investors, asset managers, hedge funds. And I was just mentioning to Marcus, nobody's really asked me about the tariffs today, despite today being the day of the, kind of a Supreme Court decision. I think it's kind of in the price. I don't think people expected, much that's different. So the market's rallying a little bit, kind of viewing this as maybe there's some costs that can go away for businesses. Maybe there's not, but I don't think people view this as a very big incremental. Most of the things that people are talking about in the meetings are around when will we see more proof cases for AI productivity. I think the expectations for earnings are more than 15% for the S&P 500 this year, 15% earnings growth. And so I think people are saying, well, wait a minute, that's embedding some AI productivity and cost cutting from the companies. Are we going to see that in the next couple of quarters, or are the estimates too high? Definitely that's one area. Two is software. Anyone who's owned software stocks in the last few months has seen some pain. So people are trying to figure out, are we near a bottom? These, which ones do I buy? I think semiconductors always come up in the meetings. I used to be a semiconductor analyst, so I think maybe the questions I get over-indexed toward that sector, but for sure, the S&P is probably 60% an AI ETF at this point. So a lot of it comes down to the semi cycle. And so people are trying to figure out when maybe the memory trade ends. So SanDisk, Western Dig, Micron, et cetera, and maybe when they should be rotating into other stuff. So those are more the questions I think right now, as opposed to, a policy at the presidential or Supreme Court level.
Gotcha. Yeah, I think, like you said, the market pretty much priced in these tariffs or the decision from the Supreme Court. In your research, and I know with all this being priced in already, have you already accommodated for the tariffs? I know we have 15% earnings growth projected this year. This earnings season was actually pretty strong, and the markets didn't respond as you would expect them to with all the micro and macro data that came out.
Yeah, Marcus, to get the stock market view, there's two things. There's the price to earnings, so that multiple you're paying, and there's the underlying earnings itself. And I think coming in this year, our view has been it's going to be not that likely that the multiple or the price to earnings expands. I think the earnings are growing. I don't think they're going to grow 15%. We think 10% is a better, safer number. But if the earnings grow 10, you would say normally the stock market would go up. And I think it could go up. We're kind of thinking flat to up 10 makes more sense than the double-digit returns we've seen the previous 3 years, just because I don't think that price to earnings is likely to expand. One, the Fed, at this point in the Fed cycle, you're going to get less boost from them cutting. And eventually, if they cut a lot, it's because things slowed a lot, not just, oh, great, there's a combination. And then two, I think people are probably maybe underestimating whether margins can go up for companies, because margins are affected. Sure, they're helped if tariffs come off, but they really matter more on pricing. If you could sell something at a higher price and not lose any units, that's great for your margins. But I think it's getting increasingly hard for you. There's lots of anecdotes I could give people from companies, but my favorite current example is Doritos and Lays are going to be 15% cheaper. Okay. I don't know many of us have gotten to the impulse purchase and been like, ooh, I'm not going to buy this but it finally got to the point where they took pricing to the point where it started hurting demand. So I think pricing is going to be an issue. I don't think the average company is going to see gross margin expansion. I don't think the Fed's going to be as helpful for that price to earnings ratio. So when I multiply the earnings side and the price to earnings, I come out a shade more cautious on the equity view than the consensus, which I think is just super bullish. And I'm a little bit more worried about the consensus.
Gotcha. And the way you broke it down when you mentioned, first of all, with the chips, they might get cheaper, but is the bag going to get smaller? Or are they taking a few chips out of their shrinkflation,
Shrinkflation, yeah, exactly.
But and then also shrinkflation, talking about all this free cash flow that is being affected by the capital expenditures used by these hyperscalers now. Not even so much in the software as we've seen software flush out, and they've started to make these announcements. We've seen NVIDIA be range bound for the last, since November. It hasn't really done anything. It's gone up, it's gone down. It can't really go through 200, it seems like. Like that's where it seems to get stuck. And I haven't looked at the market today, right before we got on. How do you see these companies growing out of this if you're seeing margin expansion?
Yeah, look, the market, there's AI revenue beneficiaries, right? And NVIDIA, obviously, having been a monster stock from 2023 through late last year, was a primary revenue beneficiary. But I think the market's transitioning a little bit to who could the productivity beneficiaries be? So who can drive out costs by predicting their employee behavior, their customer behavior, maybe growing the revenue without new hires or net hires, and then margins can go up. And we've seen that from stocks like Walmart and Costco, where they're low margin businesses, but if people think the margins are going higher, they trade at very high price to earnings ratios, 35, 40 times earnings. People are sort of transitioning away from the revenue beneficiaries, thinking that's more in the price and trying to find inefficient businesses where maybe the margins can go up. It could still be a fine stock because it grows, but I don't think you're playing NVIDIA for multiple expansion and the growth. You're saying, maybe the multiple continues to slightly erode, their earnings grow, and it can go up at a market rate. If the market goes up, 8% a year for the next few years, sure, NVIDIA could go up that much too. But I don't think people think there's as much upside because it's hard to sketch out their enterprise value to sales goes up a lot.
Yeah, law of large numbers when you get to those type of things. But even
Yeah,
as
yeah, it could be, but I think it's also just that they're probably over earning a little bit, and so the space they're in is competitive, and you're not going to pay a higher multiple because you're just worried that eventually they'll lose share on their high margin product. So I'm not negative on Nvidia, but I think you have to find companies that can benefit and drive costs out because stocks go up when their margins go up.
right. So what a company like Intel or TSM, like Intel actually had a crazy year last year. People didn't really speak about it. Like it went way up, but obviously it had privatization from the government, different things. They want Intel to succeed. Like it's good for American business. I'm doing air quotes for those listening. But inside of that, so you see a shift back to the older companies, probably stocks you were covering before, like Cisco, Intel, but TSM, everything's built on these stocks. And then you mentioned Costco's and Walmart's. People, all this seems like the shift to the old stuff is a cyclical shift back to value because these stocks are value stocks inside of these high growth IBM companies like that. Inside of all, there are people who are only going to invest in chips, and they can't invest in Nvidia right now per se because they don't want to see 8% growth. Where are you seeing the shift inside of chips?
Yeah, I mean, so it depends how nuanced you want to get, but the semiconductor industry has lots of different business models. There are companies that make very inexpensive chips that go in every industrial application, in autos, in
Texas Instruments.
doors, yeah, Texas Instruments, microchip, analog devices, etc. Those businesses had really underperformed for a long time because they had very high inventory after the COVID, and you're starting to see them act really much better over the last few months as they kind of predicted a slightly better industrial environment as they cleared out some inventory. Those businesses are different because if they overbuild, the pricing on the inventory doesn't go down. So just to make sure everyone understands, if I sell a $2 converter, maybe I sell $22 converters into the cockpit of a Caterpillar dump truck. It's a $100,000 dump truck. Actually, it's probably more, $200,000 dump truck. Me cutting my price from $2 to $1.90 for each of my 20 converters is not going to stimulate anybody to buy the dump truck. So if the economy slows and there's no dump trucks being bought, I just take my extra converters, I stick them in a warehouse, and eventually when Cat reorders more dump trucks, I just can still sell them for the same $2 that I had produced them at. So that business doesn't see huge fluctuations in their gross margins. They don't see huge pricing degradation because the value out of the product is high and the percentage of the bill of materials of what it goes in is low. On the flip side, memory, which is a completely different business, solid state stuff like Seagate and Western Dig, or classic like DRAM like Micron makes, these stocks have gone parabolic. They were all among the best stocks in the SP last year and again this year because there's a shortage. But when they overproduce, their pricing will get decimated and it will go down 90% more because when they overbuild, in order to clear out the inventory, you have to massively cut pricing. And their product is a big percentage of the bill of materials. So what do I mean by that? Let's say it's a $1,000 Dell desktop that's got $200 worth of memory in it. Well, if memory prices go to $300, Dell can't afford to not raise pricing from $1,000 to $1,100 for the box. They have to capture some margin. And so that higher price actually cuts demand. It hurts demand for the PC, right? Because it becomes too expensive. So memory isn't anywhere even in the same category of business as, say, what the analog businesses do. And then there's the companies that make the processors, NVIDIA, Broadcom, Intel, AMD. And then there's those that make the equipment that produce the semiconductors. So Applied Materials or AMAT, KLA, KLAC is a ticker, Lam Research, Testers, Teradyne, et cetera. So they probably, memory is one of their customers. And so if memory rolls over, the stocks could be hurt, but they actually are a lot cheaper in absolute terms and are over-earning a little bit less. So I think you have to kind of parse the industry in a bunch of different buckets. Marcus, I probably answered too long-winded of a question, but to me, I think you have to be careful. And I think the more memory goes up, the more you should want to sell it, not chase it, because they are over-earning and the stocks definitely will see a huge correction at some point in the next 12, 18 months.
Perfect. No, you definitely did not go too long in that answer.
So like it.
You can speak longer if you like on that. No, it's a good explanation because I don't think people realize, like you said, you can have one component inside of a $200,000 item that's only $2 goes down to $190, even if it went down to like $150, right? And they can just put that inside of their.
It's irrelevant. Yeah.
Yeah, they can put that on the warehouse. So with that side, it's more about the orders, right? The demand, like what is like when you see companies like Boeing, where are the orders? Right? But with memory, it's more about the availability. Is that would that be a good analog with that?
Right. Yeah, it's a shortage. It's a shortage that And so that when they finally get demand growth slowing relative to supply growth, then the stocks get killed. I think the problem with these things like Micron is, it maybe have 50% upside, but they also have 50 or 70% downside. And so when you look at like risk reward and up to downside ratio, stuff that's got 50% upside and 50% downside is a little less attractive than something that's got a lot more upside than downside. I think you got to be more careful with the really cyclical parts of the semiconductor industry.
Great explanation. I want to transition a little bit into, so we've seen this rolling, I would call it a rolling recession inside of sectors as things come in and disrupt different industries. We have people, you had to come in with the fintechs, with Altruist. I use Altruist as a custodian, full disclosure. So shout out to Altruist and Jason Wheat. Look, they're great people. Hazel, that disrupted the industry. We had, what do we have? A karaoke machine disrupt trucking last week. Like, people are just trying to pick what's next inside this industry, what's going to be disrupted next. Somewhere in that industry, research has to come in, right? How does your business not get disrupted by AI?
We personally do a trip.
Yeah.
Well, it could. I mean, look, I think it's healthy to have some paranoia, and I will go as far to say is if you're not worried about being disrupted at all, you're probably a psycho. I mean, you should have some doubts about what you do to motivate you. I guess I'm 56 years old. I've been doing this for a long time. So if I get disrupted, I'll probably just, learn how to play pickleball or something. I mean, but I think if you're younger, you have skills that are differentiated, and make sure that all the guys who work for me on the research side are, expert Python programmers. They're really well versed in natural language processing, trying to, the reason our institutional business is called Trivariate, and our retail business that I mentioned is called Trivector. But the reason it's called Trivariate is three variables: macro, quant, and fundamental, applied to U.S. equity. So what I try to capitalize on the fact is that I have a PhD in statistics, which I think is a somewhat differentiated skill. And I was a number one I ranked semiconductor analyst for many years. So I had a lot of experience as a fundamental stock picker, and I worked at a well-known hedge fund that is a bottom-up stock picking firm. And, then I was a U.S. equity strategist at Morgan Stanley's most read research product at the number one equity business in the world. So that was kind of the side. I sat on a 7-person asset allocation committee for the 17,000 financial advisor network. At that time, it was only $2 trillion US under management. It's bigger now because they bought E-Trade and other stuff. So I have experience doing like kind of quant, fundamental, and macro. And so I think part of what I'm trying to do is puff a few less puffs on that cigarette of my career by combining those three things. But, I still think you have to worry about it. And I think for me, the advantage is just we'd have tons of institutional relationships. And it's funny, somebody the other day asked me, what do you do for a living? And I said, I sell research on the U.S. stock market. And they laughed at me. They thought that's just so impossible that a normal human being could do that. But they didn't know anything about the fact that I just spent my whole career doing that. I think in terms of the AI implementation stuff, though, Marcus, like taking your question more seriously is, look, we spent a lot of time doing that. I published a research note for my institutional investors this week where we took every word I've ever written and said, put it in Claude and said, is there any kind of sentiment that's coming from my words that actually has predictive value? And we found actually there was kind of a 1 week predictive value. When we said more negative things about the market, on average, the market did worse the next week than we said more positive things. So I think that's because we're reflecting the questions we get from our institutional investors. We do whatever it is, 16 institutional investor meetings a week or whatever the average is over the year. It's hundreds of meetings. And so at the end of the day, I think at some level we're reflecting the good questions we get from investors and trying to react to new information and new news to figure out where our mind's changing. The older I get, the more I realize that like I have to unlearn things, or things have changed, or I have views now that I used to not have. Like, for example, I don't think valuation works to pick stocks. We can get back to that. But I think you have to always evolve your thinking. And if you're not at least somewhat open to that, then maybe you're more vulnerable to being made obsolete.
Perfect. So it sounds like for one, well, maybe you sound like you're on the back 50, as my stepdad likes to say. You're on the back side of 50. But two,
56. I'm going to get close to 60.
Hey, that's 60 is the new 20. Look at Bill Belichick. I probably shouldn't have said that. But you're embracing AI, right? Like, that's what you're saying. Like, you're embracing AI. You have guys.
We bought an NVIDIA chip 3 years ago, put it out on EQAX, the public data center read. We have a very quantitative firm in terms of how we do process. Every day for the biggest 3,000 U.S. equities, we download or compute hundreds of pieces of information, and then we use that to empirically test outcomes, and that's part of where the research on the institutional side started. The reason we started TriVector Research is because, I felt like we needed to make more, help advisors and individuals more. I'm a CNBC contributor. I'm on once a week. People come up to me all the time. Hey, how can I access your stuff? And so The problem with the Trivariate institutional business is we sell it for hundreds of thousands of dollars a year. So no normal person is going to buy it. So we started TriVector because for $100 a month, we can give them more practical advice, why they should save, fully invest in the equity market. How do they think about, the cost averaging new investments, what they're actually getting when they buy certain ETFs, because they don't actually always give them the exposures they think,
Mhm.
uh, you know,
IGV.
that kind of stuff. Yeah. Comparing ETFs, that kind of stuff. So I think that business is kind of born out of just capitalizing the database we have. It took us 9 months to build a database. It's the fourth time I've done this in my career. We spent several $100,000 a year on data for the database. And then we're using a lot of technology to kind of quickly process information. So I'm hoping there's some harder to crack edge by all that investment. But your question's right. Like, people should worry about that. And we're very open to embracing technology for sure.
It took you 9 months to build up your database, and you mentioned
That's
that
several years ago. Yeah.
you analyzed, and that was a couple years ago. So compared to then, like when you had to do some research back then, like you were writing a weekly newsletter or putting out weekly research, how long would it take you to do that then compared to with AI now? How long does it take you now? Like how much does AI increase your productivity? How do
Well,
you actually use it?
I mean, maybe a fair thing is like when I was a U.S. equity strategist at Morgan Stanley, I had 9 senior people in New York and 4 people in India on the team. And now we have 4 people spread around the U.S. on the team, and we produce way more today than I did when I worked at Morgan Stanley. We can process information more rapidly and assess more. I think the challenge for me, actually, Marcus, is that it's one of my 27 weaknesses. Is I always say yes when one of my friends or clients says, "Can my niece, nephew, kid work for you as an intern?" And the problem is, no intern can add any value anymore because all these kind of Gemini and ChatGPT and Claude are like having a million interns. So it's hard to come up with projects where a young kid can add value. And I used to be able to, give them projects. Hey, tell me what all the acquisitions and divestitures Microsoft's made in the last 10 years and what technologies they're buying or investing. And they would go away for 2 weeks. But now they come back in like 15 minutes, right? Because ChatGPT is pretty good at that stuff. So we're constantly trying to figure out what we can use interns for. And that process leads me to a lot of it's in the natural language processing work and trying to figure out like where there's errors or where there isn't. We search every earnings call transcript and we really look for information there. And it could be anything related to AI or cost cutting related to AI. And then once we cluster the stocks, we then say, are they even seeing better revisions, higher multiples, outperforming? Are there any like tangible evidence of AI implementation? Because we spend a lot of time on like who's going to be disrupted by AI, who's impregnable to AI, who's a beneficiary on the cost side. Stocks that are getting more expensive are really just stocks that are more likely to benefit from AI or be impregnable. Stocks that are getting cheaper are really just stocks that are more likely to be disrupted. I use mean reverting valuation to buy stocks. I'm just buying companies that have a higher probability of losing and selling stocks that have a probability of winning. And that I don't like that idea. So
I
we
mean,
use
so
AI a ton all day, and it's massively increased productivity. One way that the people listening wouldn't appreciate is data ingestion. So if you buy data, it can come in all kinds of weird forms and columns and semicolons and all over the place, unstructured. It could be videos or it could be photos or whatever. And it used to be you would spend a lot of time formatting the data before you could even read it in and analyze if there's any information in it. And the AI tools are really awesome at data extraction and ingestion and save tons of time on that. I'm sure some of you've used that. I don't know if you've even used that in a very basic way in your personal life, but like, have you ever tried to email 25 people at once and there's like semicolons in between them all? You tell it to get rid of whatever stuff like that, but multiplied by 1,000 or 1,000,000 for big data sets. It's really efficient on that kind of stuff.
Thank you for tuning in to this insightful episode of the Main Street Meets Wall Street podcast. We hope you gain valuable insights on how AI is reshaping the financial landscape. Don't forget to subscribe to our channel and hit the notification bell so you never miss an update. Stay tuned for next week's episodes where we'll dive into part 2 of our discussions with James Callahan on the national debt and Adam Parker as we keep going into research. Also, you can find more stuff on our LinkedIn newsletter, the Wall Street South Journal. We'll explore the intricacies of the government debt, how government manages the debt, and the impact on both Wall Street and Main Street. You won't want to miss it. Join our community by following us on social media and share your thoughts on today's episode. Your feedback helps us bring up the content that you care about. Until next time, Keep investing wisely and stay informed.